and welcome back to BloombergQuint. I'm in conversation with Vikash Kumar Jain, the investment analyst at CLSA, who tracks the oil and gas space. My first question to you would be, what do you make of the results of the oil marketing companies? Were they on expected lines?
We expected both refining margins as well as marketing margins to be stronger. That was our expectations. But there has been some disappointment clearly on reported refining margins. Despite Singapore benchmark rising by about $2 a barrel quarter on quarter, the OMCs haven't really reported that kind of increase in their core margins. The reported margins have also disappointed with consistently lower inventory gains reported by them. So there's been some disappointment on reported margins very clearly over there. So that's why versus expectation, OMC results for the last quarter have been lower than that.
So do you expect this weak trend to continue? What is your outlook on the oil marketing companies for the second half of financial year 2018?
See, we generally have a positive view on refining margins, but particularly talking of third quarter, we've seen marketing margins come off from the strong levels that we saw in 2Q, and even Singapore benchmark GRMs are down right now about $1 per barrel on a QOQ basis quarter to date. So there could be, third quarter could be a relatively soft quarter on both marketing as well as refining margins. Nonetheless, I think at least on the refining side, we believe that relatively strong margins should continue for the refining, for refining business in general over the next over the small, short to medium term.
So from valuation perspective, would you prefer downstream or upstream companies?
See, in case of upstream, what we recognize and what we believe is that there are some of the large cap upstream names are not really building in the full benefit of crude price increase. Crude is about $65 or so right now, and Brent, the large cap names are building in closer to $50 or so. There's still some sense of fear amongst investors that subsidies will come back. I think around the current crude price environment, we don't really see a big subsidy burden, any subsidy burden coming for upstream names. So if we take that picture into account and we compare the valuation of Indian upstream names versus global peers, they're trading at a significant discount. If the subsidy problem is behind us, then there is no reason for them to trade at a significant discount. So there's clearly a big re-rating trigger for upstream names. On the other side, the downstream names are trading near peer valuations globally. So, from that perspective, clearly upstream looks a better risk-reward bet than downstream on an overall basis.
So do you? What is the outlook on the crude oil prices? Do you expect it to remain at elevated levels?
There's clearly some fear of geopolitics and some hope coming into the OPEC meeting towards the end of this month that there could be some action which would further strengthen crude prices. We are of the view that crude around 60 is what we see. So somewhere around this or slightly lower is what we see. But clearly with all the action that OPEC has taken, and why I say action is not just the policy of cutting fuel, but adhering to those cuts and production cuts is something which should clearly put a floor to crude prices. So we see around 60 level crude prices to be roughly where we see crude between 55 and 60 or around that level.
So given the rise in petrol and diesel prices, do you expect the gas demand to grow, and what is your outlook on the city gas distribution companies?
See, we actually initiated on the city gas names recently. We came out with this big detailed India gas report just a few days back, last week, where we argue that city gas is going to be the best way to play Indian gas volume growth story. Of our assumption that Indian gas consumption will rise 40% in the next 6 years versus a decline of 10% in the last 6 years, city gas will see a doubling of consumption as a sector. So that's actually the best place to play the city of the Indian volume growth story. On an overall basis, gas will be gas consumers or gas distributors globally should be relatively better placed because we see an oversupplied gas market globally, which means that the gas to oil ratio should be in favor of the gas plays. So therefore, it will be relatively, on an energy equivalent basis, gas will be much cheaper than oil globally, which should support city gas players. So with that demand growth and with all the focus, I think there are two big changes which government has done, which are fundamental changes for the city gas distribution plays. Firstly, the raw material cost has come down in the last 2 years after government put them at the top of the allocation policy and guaranteed them domestic gas. Earlier, they were forced to take a lot of LNG, even for residential and CNG use. That has changed. On the other hand, increase in taxes for petrol and diesel has meant that competing fuels prices have remained expensive. So that has given them a big cushion where they are able to price it at a significant discount to competing fuel, and with raw material costs falling. So lower raw material cost and higher competing fuel prices has given them a lot of cushion, which has given them the pricing power. And that, I think, puts them in a good place with all the volume growth as well as ability to increase margins. So that's really a place that we like.
So getting back to the upstream companies, now in the second half of financial year 2018, the gas prices were hiked. So do you expect them to benefit, and what could be the incremental benefit that would come in?
See, gas prices were hiked, and that's something which is already built into our numbers, and this was a significant hike, but nonetheless, the most important thing is that first half of FY18 is where possibly was the lowest for gas prices. We see another increase of about 7-8% coming in April when the next reset happens, because it happens in every 6 months. So, I think we are seeing gas prices domestically that the worst is behind them. So for an upstream company perspective, if you think of it, like the larger upstream companies also have production increases, so volumes are rising. Gas prices have risen, crude is stronger, so both realization and volume, which are the key drivers, have seen the worst, and they are improving. So that really puts the upstream space in a good, good place.
So if I break down the oil and gas sector into different parts like city gas distribution company, gas transmission companies, downstream and upstream, what will be your pecking order then?
See, ideally, clearly, it's more dependent on valuations per se. I think definitely, like the upstream names may not be so exciting. If you talk of excitement, possibly city gas is the most exciting space from that perspective. But a valuation for a particular stock in a particular area could make it a much better play. So I'm not going stock specific. City gas is a good place. Gas transmission is a very good place. But the problem is there is very few opportunities to play that on a pure basis. Because there are other companies which have gas transmission, but they have other businesses also, which may offset the gains of gas transmission. So if there is a way that one could get exposure on a pure basis for gas transmission, that's a good place. And upstream names selectively, depending on where valuations are, would be what we like.
That would be all, Mr. Vikash. Thank you for joining us, and thank you for watching BloombergQuint.